Welcome, everyone. Today, we are going to be talking about diving deeper into the private investment due diligence with a guided tour of the private placement memorandum with Chris Carsley of Kirkland Capital Group. So first, I'm going to kind of give you a brief who Verivest is. You might have received the invite via Verivest. So if you already know, feel free to just follow along anyways, but we are a real estate investment platform designed to bring transparency and trust to the middle market investing place. So our mission is to create and enable the conditions to increase the speed of trust in the private middle market real estate investment space with the goal to help investors to direct their capital to those sponsors and managers who can demonstrate they are trustworthy stewards of capital. So here is what the sponsor directory looks like. So you can find a sponsor by MSAs, you can search by minimum investment, you can search by strategy, by open opportunities, and every sponsor has their background check for you to see within the past 10 years. And you can also actually directly connect with a sponsor and email them through the site. So that's also a cool way to just connect directly. And then to be on our platform, there are obviously super extensive requirements. So no personal or business bankruptcies, petition of 7 years, no unfavorably resolved lawsuits, no regulatory sanctions, no felony criminal convictions, and sign the Verivest Code of Conduct. So there's two levels. There's the gold level and there's a Verivest verified level. And I will go through the verified gold level here on the next slide. So here we have Kirkland Capital Group, who is joining us today. They are verified gold members. So they agreed to have all their active opportunities monitored on an ongoing basis to prove they are following the rules of the deal's operating agreement and allocating money the way that they said they would. So here you can see Kirkland Capital, their primary strategy is private lending, their primary property type is multifamily, also with their investor capital managed number, and that they are 100% monitored. Also, sponsors can engage us to verify their track record. So here you can see Kirkland Capital Group's track record very transparently with the inception dates and the investment amounts. So you don't have to do that research. So that's another awesome feature of the platform. That was super brief, but if you would like to find out more about Verivest, please reach out to me or connect on the Verivest Community Network. That's an awesome resource to talk to other people in the industry and find out when we have more educational events like this one. So I don't want to take too much of your time because we have the expert on the line who's ready to dive in with you. He has a diverse investment background spanning 25 years in covering traditional assets, hedge funds, venture, and fund of funds. He is the co-founder of Seattle Alternative Investment Association, the co-head of Chartered Alternative Investment Association in Seattle. And then his expertise lies in portfolio construction and risk management and operations, compliance, and regulations. So I will go ahead and give the floor to Chris and he will take it away.
Today, we're going to be talking about the private placement memorandum. In the last segment we did with Verivest, we talked about the 4 key points that were important to making a successful investment. We talked about documents, fees, operations, and then the transparency of a manager. And one of the things that we had some requests for was to go through and say, hey, can you do a deeper dive on some of these sections? And one of the things that I started with is great. Everyone, when you get a private placement investment, you need to dive in. You need to understand the documents. They should be shown to you. And you should have ample time to review and then ask questions, from the manager. So let's dive in. One of the most important documents that's going to give you that introduction is the private placement memorandum. Here's a simple definition. According to, thank you to the people at Investopedia, an offering memorandum is a legal document that states the objectives, the risks, and terms of an investment involved with a private placement. I'm not going to read the rest of it. You guys can have time to read that. What it really is it's important because it literally is to the rules of the game. It's an explanation of what you're going to invest in. It has all the parameters and risks that you need to understand as an investor of how you will be treated. One of the other documents that goes hand in hand with this is your operating agreement. Often not, you'll see in a private placement memorandum references to an operating agreement. It'll kind of go back and forth between those two. But the meat of what you're going to be diving into is in that PPM. It's going to give you an explanation of, like it says here, your business operations, risks, and the management team, historical performance, fees. It's going to run through a little bit of everything. Today's objective is I really just want to be able to go in and say, how do I get to a no more quickly? Most of these documents will range anywhere from 80 to 100 pages. So how do I read dozens of these and get through them in a timely fashion? One of them is just experience of having read hundreds and hundreds of them. The other one is being able to identify what's important to you. And today I'm going to walk through a number of different points that I guide into that are important to me, that allows me to go through a very large document and get an idea very quickly if this is something that would match my portfolio. Is it something that I need? Is it going to be good for me? And does it match how I think about the world? And get to a no quickly. So one of the things that, and that's important, because I believe everyone should read their documents. Everyone should read their PPM. It's important. It's the rules to the game. I always tell people, I go, you really want to go in and try and play Monopoly with a professional and not read the rules of how to play. If something goes wrong, that game is going to be rigged against you. So don't do that. Read the document, come back with solid questions, and don't think anything like is off the plate. You can ask questions about anything. There are no rules to the level of due diligence you can do. My previous due diligence was, I think I spent 8 hours after going through documents on an on-site verification. I spent 8 hours with a multi-strat hedge fund because it was that complex. There was nothing that I couldn't ask. So don't be shy, and don't ever fall into the trap of I don't want to look like the idiot, so I don't want to ask the dumb question. Ask the dumb question. Sometimes that'll lead you down a rabbit hole that maybe will allow you to, say, no, I don't want to invest in that. That I didn't like that answer. So that's the key. Get to the no quickly. And one of the easiest ways to do that is pull up this document, read through it. One of the things, these are the key elements that I like. Go through your business objectives. Understand your fees, your fee structure, the types of fees, the fund expenses. You'll see, I'll talk about this a little bit later also, but this is one of those fees that it's usually in one short paragraph and it looks like a kitchen sink was thrown into that section. It's important to understand what is embedded in fund expenses and how the manager thinks about fund expenses, because this is an area that can shift and move as a fund grows or expands or maybe becomes more complex depending on the nature of the fund. If you're talking about particularly a hedge fund that may have some style drift allowed, those fund expenses might move also as they come in and encompass other additional strategies. So that's one thing you got to really understand, and it's an overlooked expense because everyone always talks about like, oh, my fund charges 2 and 20. That's a management fee of 2% and an incentive fee of 20%. And no one ever seems to think about fund expenses, but there's a lot embedded in there. And so we'll dive into some of that. And there's a slide here that I'll pull up. Organizational costs. Another thing that it takes money to build a fund. It's inevitable. You got legal fees, you've got time and effort. How are they calculating those organizational costs? How are investors paying for that? Because it's actually pretty common that the investor will pay for that organizational cost. Liquidity. Everyone has different liquidity needs. Does this fund actually have liquidity needs that match something that works for you? Does the liquidity match the style of investment? Those are a couple key questions you need to understand. Partner contributions. You'll get a joke out of this one later on when we get to this slide, but it's another name for this that everyone commonly knows is skin in the game. Do these managers, are they putting money into this fund? One of the questions I had historically was when you see very little money put into a fund that someone's trying to sell you, you always ask, well, you don't seem to have much money in this fund. How about we talk about where all your money's at? Because maybe that's a better investment. I say that tongue in cheek, but I did ask that of a manager once. He didn't like that question. Leverage. It's a component. It's used in a variety of different strategies. Very, very common in the hedge fund world, depending on the nature of the strategy. But leverage is something that's extremely useful, but it's also something that can turn around and bite you, as we saw in 2008. A lot of different strategies, had their lines called, things were pulled back, and that creates, forced selling and can put a lot of stress on a fund in times when maybe there's nothing really wrong with the underlying investments, but a third party that's providing leverage is now added stress to that system. And at the end of the day, the people who pay that price are you, the investor. So you need to understand what's the leverage use, what's allowable, and how much are they using, and really get into the head of the manager. And then valuations. Super important. You're dealing in a private investment. Not everything is going to be a public security. There are hedge funds and a variety of other structures that deal with public instruments that can be valued through public means on a daily basis, but often that may not exist. So you need to understand, how are they valued, who's valuing it, what's the double checks, and where is the valuation used? You'll find that valuation can be used in a lot of different ways within a fund. This is one of the darlings that you'll see. I do I write a lot of papers for people, and I've had some requests for discussions around related party transactions. A lot of managers and a lot of documents that you'll see will come out and say, hey, it's a super big benefit to you as an investor because we are vertically integrated in our investment structure. And so we have all these related parties that help us succeed in providing positive returns or controlling risk, or both. Just be careful that you got to really understand, and you got to link some of this back to like the fee structure. And we'll walk through this later on, where are you really saving any fees because they've got a bunch of related parties, or are they just stepping in and taking multiple layers of fees, from you? And how do you double check those related party transactions to ensure that, they're being, utilized correctly by the managers? Let's dive right in. And one of the things you'll see here, I actually used a real PPM, obviously took names and everything else out of it so that we can actually look at some real language and understand, how this PPM was structured, for better or worse. There are some things in this that I don't necessarily agree with. They definitely raise red flags for me. But just note, nothing in this means fraud. And that's important to understand as you're going through this. Just because someone has something that might be a little wonky, doesn't mean they're bad people or something could be wrong. This is a walkthrough and a tutorial to understand a PPM so that you can understand what fits you and also where things might happen. So there's a lot of things that have happened historically that have led to fraud. One of them being related party transactions. One of the reasons I threw it in there was historically, you've always found people, when something goes wrong, there's some level of hidden fees and structures in related party transactions. So first is the business objective. It'll usually be the first part of a PPM. You want to walk through and understand, does that business description in the PPM match what you've been told? I assume by the time you're looking at a PPM, you've probably had an intro phone call with the manager. Does it match your notes? There again, because right off the bat, sometimes you'll read through a PPM and you think this is weird, but I've had this happen where you talk to somebody and you go read their PPM and it wasn't exactly what you discussed. And so you're wondering if they sent you the wrong document, or did something change since the document was created versus the time you talked to them. This is the very first step to understand. If it doesn't match this early, that's an early warning sign. And you probably need to think about, well, here's a set of questions already. What am I really getting into, and why did the manager talk about something that doesn't match with what the document is? Do you believe this is a solid investment? I mean, is that something that really matches with what you need once you read that description? can this business objective take advantage of, some inefficiency? Is it feasible when you read through this? Does it make sense? Is it easily understood? I have a very simple rule. If I read through a business objective of how they're going to invest and I can't understand what they're doing, something really super complex, if it's not your forte and you can't get your hands around it, just walk away. I mean, I know that's a pretty simple rule, but it'll keep you out of trouble. So you're not trying to understand what maybe went wrong because you didn't understand what was being done. Are they overpromising in their statements? That's another thing. Or in fact, are they promising anything? I mean, I wrote that in there. I mean, you just be very careful when people use certain words of guaranteed or promising. Nothing in the investment world that I've been aware of over time can really be guaranteed or promised. In times of stress, even things that have guarantees usually can fail and not have the monetary means to support them. So it's something to be, wary. Example here, if they're doing development projects, and by the way, the PPM that I am using is a real estate fund. So we'll keep it on track to what Verivest and Kirkland Capital does in the real estate space. If they're doing development projects, but the fund has a short window to liquidity, well, that's a problem. That's an immediate red flag of if they're offering liquidity and they're doing development projects, there's already a mismatch in duration. They've already got an asset and liability mismatch. And if they are doing that and they are offering, then that would be a good question to bring up. How are they actually making that happen? How do they structurally make that possible to create liquidity in a fund that, should have a longer duration and tie up of capital, especially in real estate development projects? So that's right off the bat, a number of things to think about with regards to business objectives. Does it match what you need? Does it make sense? Say and do is matching. And, understand the nature of the investment so that you can, make sure everything that they're going to be talking about and the other stuff we're going to be walking through makes sense. Fees. This is what you pay to be a part of it. I mean, if anything you're going to read in a PPM, this is something you really need to understand. What are you paying to be involved? I have literally had professional investors tell me, and I say professional, they're high net worths who call themselves professionals. They've said that, they don't pay incentive fees or they don't pay certain structures or there's no fund expenses or anything else. And, I read through their PPMs for free and I point out to them the layers and layers of things that are occurring. So this is real language from the PPM that I read through and I'm presenting today. This is nothing added here. This is literally, I copied and pasted straight from their PPM. They have a management fee of 3%. They have development fees of 6%, disposition fees of 6%. They have general contractors fees of 12%. There's origination fees if they actually act as the lender. And then I threw in the Class D units here. It doesn't really come across as a fee in the language, but that's actually the fee that will be viewed as the incentive fee. That's the class of units that they own that will participate in some level of upside. Sometimes it'll be 20, 30, 40%, whatever. It'll be different by fund that you look at. Now, this is something it's a development project, I understand. And this goes back to that related party transaction. You'll find that throughout this presentation, there's no one section that doesn't overlap another section. And that's where you just got to go through these and ask questions and become familiar with them. Because when you look at fees, it kind of goes into like, wait a second, why are they talking about general contractor fees? Why are they talking about origination fees for lending? Throughout this PPM, they actually say that they will act as the lender, they will act as the general contractor, they are the developer. So from beginning to end, this manager you're working with is taking a lot of fees. There's a lot of layers of fees, and you really need to ask the question of, hey, give me an example. What am I really paying in full freight here? If I invest $100,000, what can I really expect end to end in a standard project that my entire fee base would be? That's a very valid question, and they should be able to provide that to you. And then you can get an idea But you can see there's a lot of layers here. And some of these are situational, but I can guarantee you this vertical integration that they talk about in the document, they make it say, oh, we don't have to be the general contractor, but why would they pass that off to someone else? It's their project. They're going to take every layer they can possibly get. So let's just be realistic. You're going to be paying all these fees to this particular manager. And it's worth the time to say, great, let's dive in. Give me an example of what this actually means to me as a base level of fees. So, I mean, that's, and there again, also, if anyone's got any questions, Brittany, please interrupt me and we'll answer questions because I'm kind of looking and monitoring some smaller screens here, so I don't have chat up. And this is the next section. I mean, obviously fees is pretty important. I couldn't fit it all on one slide. So this is that Class D share. This is that further dive into incentive fees. And so they supplied this little tiny chart where they could come in and say, hey, depending on the amount that you invest will determine, what the profit split is. Okay, so if I write $100,000 check, I'll 53% of the return goes to the manager. So above and beyond, now I laugh, they only state here in this little chart, the management fee of 3%. They don't bother to mention out and sort of list, well, here's all the other fees that you would basically be paying throughout the life of these projects. But as a Class B investor, I have an incentive fee of 53%. Okay. And I have a sarcastic kind of comment here. You can take it for what it's worth. I've done this a long time, and I've known some top-level hedge funds. The standard in the industry is 2 and 20. There are some guys out there in the hedge fund land that they literally charge like 50% incentive, but they've been doing it for 10, 15, 20 years. They've proven that even at a 50% incentive fee, they can beat the market and stay alive. And these guys can do it with billions of dollars. Okay. Just to give you a reference, this PPM is from a relatively new manager. So that's pretty aggressive to say, I'm going to charge the same kind of incentive fees that a global titan in the hedge fund world would be charging. Okay. I mean, every investor to their own. Like I said, there's nothing fraudulent about any of this. There's nothing illegal, but this is where you need to really dive in and understand, is that something that would work for you? Is that something that, does that make sense to me? To me, this was one of the things that kind of jumped out at me is like, okay, that's a pretty bold statement. You're putting yourself in a very, very small circle of unbelievable managers that believe they can charge that level of incentive fee. Just make sure it fits your palate. Fund expenses, some of the hidden stuff. So this is actual language. Fund expenses shall include, but not necessarily be limited to the following fund organizational costs. Let's mark that. Remember that statement. Tax preparation, CPA fees, legal fees, and any other expenses associated with the operation of the fund and the management of its assets. Okay, that's a nice broad term. The fund is responsible for fees related to marketing its properties for sale, including broker and agent fees. The fund is responsible for reasonable fees related to marketing this offer to potential investors. Okay, this is one I'd like to point out. That line there about marketing fees, pre-2008, it was pretty common to see marketing fees covered by the fund. And these are marketing fees related to the efforts about the expenditures to go raise more money for the fund. And they would push that onto the investors. Post 2008, at least in the institutional world, there was a lot of pushback on this about, hey guys, we're not really sure if that's a fee that should be borne by the investors. There again, there's no written rule in this. This is something you just have to develop your own personal taste for. And so it's something worthy to go in and ask the question of like, well, what has marketing expenses generally been? Get that detail. Understand what it really means and what your share of that will be. And if that's something there again, that's palatable to you. I will tell you that institutions have not been terribly happy, especially by big Wall Street funds that had very large expenses for their marketing. The manager shall be reimbursed for all reasonable out-of-pocket expenses incurred on behalf of the fund, which shall be considered fund expenses. Great. The manager has On behalf of the fund, borrowed money to cover some initial fund expenses. It may, in its sole discretion, issue units in exchange for forgiveness of debt. Okay, that's a little different of term. That's not a very common term in a lot of PPMs, but in relation to being a developer in the real estate space, you might see language to that term. There again, you need to understand how much might that occur, what's the dilution, how much money are they giving away, and what's the real base, there again, cost to you as an investor. And you heard me say this earlier, fund expenses is a place where people can throw everything, including the kitchen sink in. Like I said, it'll usually be a long paragraph with a bunch of, commas separating terms out. Just make sure you're comfortable with all those terms. And one of the things that in this PPM that we'll see in a later slide is that first line item, the fund organizational costs. At no other point within this document is that ever mentioned. This is the only part and the only section of the PPM that talks about what those are. They're not itemized out. I'll save that for the later slide, but we'll come back to that. So obtain a list of these fees, go into past deals, get the detailed information. What did this really cost? I mean, they should be able to itemize this out or have an idea. If it's an emerging manager, it's their very first fund, maybe they won't have a lot of line item detail from past deals, but maybe they'll be able to give you, any good fund manager, they're running a business. They should have this in some kind of pro forma and understand what these costs would be so that they understand they're going to run a successful manager. So there again, ask, get this information, get that line item detail, understand those costs and how that would affect you, because fund expenses can be a secret space to where a lot of fees come your way. And, also on your investor statements, see if you can get some of this line itemed out, separated out so that from your standpoint, if they're audited, great, you might be able to see that. If they're unaudited, you're going to have to ask for that detail so that you can understand and you can track effectively. If fund expenses spike, there again, you should ask the question, why did it spike? Because don't just track your returns. Because one of the things is, a fund can actually take on more risk and increase their returns or deploy more leverage to increase their returns. And maybe their fund expenses doubled, but it was muted and it got, sort of buried in an increase in returns. And that's something that if you didn't look at some of the line item detail, you wouldn't be able to see that occurrence. So I know that's a lot to ask for a small investor, but that's the kind of information you should be aware of and try to get that information so that nothing surprises you and you don't wake up one day and go, wait a second, when did fund expenses get to be, 1%, 2% of the fund? And I will tell you, there are some fund expenses, there's a structure in fund expenses, and be very careful about this. When this PPM did not have this, but there's something called a pass-through where they will pass through every expense as a fund expense. And it gets pretty scary. I've seen some PPMs to where fund expenses can be upwards of 9% fee. I know that sounds large, but I've seen it. So let's dive into the next. We were talking about organizational costs. Okay, what a surprise. As I stated earlier.
Chris, I got a question for you.
Yes.
How do you know until you are already in the, how do you know until you are already in the deal? I don't know if I asked that.
So how would you get this information before you're in the deal? Like I said, two ways. One, it's already a functioning fund and they've been around or they've run a previous fund. Ask for that detail. Ask for that information that you would like to have them walk through an example of how that played out and understanding some of that level of detail. If someone's not, going back to those 4 ways to, make sure your investment works out. One of them was transparency. If you find somebody's like, just doesn't want to put the time in or provide transparency, okay. You should approach with caution. But to answer your question of how would I get this? Well, you got to ask. And I understand that's what I'm trying to do in this presentation is really kind of give you some of the questions of what to go after and what to ask. And so you would get that, you would ask that line, if it's line item detail, if it's a manager that had a previous fund. If it's a new fund, then you've got to go the other way. And then hopefully you're dealing with somebody who's running their fund like a business, and they've actually looked at it and thought about from a pro forma standpoint of, well, what would be that expense, and how do I make sure I cover the expenses of my business, and get the numbers, on a forward-looking basis, because maybe they're relatively new. And don't get me wrong. I mean, there's advantages to dealing with new managers. It's just a different way to assess that risk of like, okay, they haven't gotten there yet, but I still can ask that question because they should have at least thought about it.
I have one other question too. How do you know if a fee is reasonable?
That's a good question. A fee is reasonable. Start with a general benchmark. In the world of alternative investments, you can always start with, most alternative investments tend to be kind of a 2 and 20. You'll find it sort of a gravitas, like the 2 and 20 mark is kind of like a black hole sucking everything towards it. And you'll find outliers in that where certain people, because of the nature of what they do, is not as complex. So they'll charge less management fee and incentive fee. You've got to go in and make an assessment of the complexity of the investment. How complex is it? How much work does it take? What kind of team do they need to manage? And, if you're going to get the best teams, like at my time when I was, working for a hedge fund, you got to pay the right people to work 18-hour days and do it every day and then on weekends. And there's a cost to that. And sometimes that'll, be passed on to the investor, a fair amount of those costs. So it's a combination of understanding the nature of what the fund does and the level of complexity, and also a level of the targeted return. If you're looking at something that's, we'll use Kirkland Capital Group as an example. We're targeting a 9% return. Most of the debt that we write is a gross return of 11 to 12%. If I was going to come out and charge you, a 5% management fee, we're working with the absurd here. Okay, that's clearly not warranted. I basically took almost half of the entire gross return in a management fee. That's probably not warranted. I'm trying to give you some scenarios to look at because there's no written rules of what's acceptable. You have to come up with a benchmark of what's acceptable to you as an investor, but what's also, don't look at just one fund. Go look at like 10, 15 different funds. Don't spend a lot of time. Just go grab 10 funds that are all very similar and look at their fee structures and kind of build a line in the sand for yourself of like, well, where's everyone sort of gravitating to with regards to a certain strategy? You'll find that there won't be a lot of deviation. And if someone does deviate, well, if you're a super curious person, you can call them up and say, well, why are your fees so much lower, or why are your fees so much higher? If you're just curious, or you're looking at that particular fund, you can dive in and say, well, wait a second. Everyone else is charging, 1%. You're charging 3% on a management fee. Walk me through how you came up with 3%. I get asked all the time, how did I come up with 1.5%? Why am I not charging 2%? I mean, it's a totally valid question, and they should have an answer pretty much ready to go. I mean, I know there are some people out there that just, well, I charge 2 and 20 because that's what everybody else charges. Okay, I mean, it's not a wrong answer. It's not an answer that clearly put a lot of thought into how to build their business and understanding, do they understand their fee structure in relation to the investment and the cost of their business? They were just grabbing, the center line. And maybe that's okay for you. Maybe it's not. I hope that answers your question.
Yes, thank you, Chris.
Okay. Yeah, no, a lot of this it's an art. This is not a science. So, welcome to why lawyers create these documents. If it was a science, lawyers wouldn't be creating these documents. I'm sure I just made some lawyers upset. That's okay. It won't be the first time. So organizational costs. Well, this is where this document kind of interesting. Is they say you're going to pay for this. They stated it in the earlier slide, but there's no mention of what it is, how it's treated. You have to ask this question. One of the things that I have seen time and time again is managers who really, maybe it's their first fund. I mean, it could be a variety of reasons why they just don't know everything they're going to be doing. So they go to third parties and pay full freight and end up paying, and I'll take this number with a grain of salt because there are some strategies that are super complex and they do require multiple levels and they'll cost like 150,000 to create all the documents and structures. But for a pretty generic investment fund in the private space, 150,000 in today's world is a lot to be paying to build it, in my opinion. And so much to the fact, I think, I make reference here, the federal regulators are even coming down on this. Like I was just talking to the Washington State Department of Financial Institutions, last month, and they're trying to peg for their own benchmarks. Well, when they're reviewing new managers that are coming out and looking for registration, what's really an initial acceptable amount? I think their amounts may be a little low, depending on the nature of the fund. You can't peg everybody to the same benchmark, but they were kind of looking. It's like, listen, if you're passing on organizational costs more than 50,000, it's a red flag to them. They'll ask you a question about it because they're trying to verify how much money did you spend to build your fund and how much are you putting on the backs of your investors. So think about these organizational costs is the manager's way of basically passing the cost of building the fund onto you as the investor. And if I went out and spent 150,000, that could be a large amount of money that you have to carry. So it's actually really important. And it was really funny in this PPM that we read through, they say you're paying it, but they don't give any detail. So that's immediately for me, that's a scary, scary item. I'm definitely asking that question. I'm going after them. I'm going to see what did it cost to build it out. Show me your financials. I mean, because anybody can go, oh, I only paid 25K. Okay, great. So could you line item out exactly how much that's going to affect my return? Because that's going to create a little bit of a hole. And if it's a fund that's been around for a while, will have all the organizational costs been paid because I'm getting in year 2 or 3? Or how does that, am I doing a catch up for the other early investors? If you're the early investor, how much of that freight are you carrying? These are all questions you need to ask with regards to, the timing of your investment, the age of the fund, and the size of the organizational costs. So it can be a little scary.
Hey, Chris, we're having lots of questions come in, which is good.
Okay, let's fire away. Questions are far more entertaining than me looking at text slides.
This is very helpful, I'm sure. So do you see any value in using a ratio of fees to IRR to compare opportunities?
I've never really done that. It's more about the IRR than the fees. IRR is a forward-looking return that can be manipulated. And to some degree, especially within real estate, if you're looking forward and someone's got a targeted IRR over the next 5 to 7 years, there's a lot of fudge in that number. And a lot of people will manipulate and maneuver models to try and target an IRR. So it's not that you're looking at a bad ratio or something of a comparison. You just got to be careful about your denominator there and how that was calculated, and maybe even apply a discount to an IRR that's provided by a manager to give a more conservative view. I've never used that metric personally. It's more of I like to look at a standpoint of, do the fees really mesh up more with what I understand in the broad market? I'm a little biased because I look at literally dozens of funds and read through their PPMs. So it's easier for me to come up with like, okay, hey, these guys are a little off mark, or this is right on the mark. Especially in syndications, because you can have, just like this fund here, this development fund, in syndications, you can have multiple layers of fees. And are they mitigating fees? Are they charging a financing fee? I mean, some people I know, they're like, hey, I'm not going to charge on financing. I'm not going to charge on disposition. What are they giving up? And are all the other fees in line? Is the acquisition fee in line? Is, the management fee in line? And that's just a matter of sometimes doing it. So nothing against that ratio, but just be careful about the denominator, the IRR calculation, because it may not be exact as you like, because it is a return calc that's forward looking and it can be manipulated by very smart people.
Thank you, Chris.
Any other questions? Okay.
That's, yeah, they'll come through, but I'll just.
Okay. Yeah, no problem. That was a good question. That's,
Yeah,
I
it's
mean,
great.
there's lots of ratios to look at. It's just a matter of, how you want to benchmark stuff. I just say, I always approach IRR calculations with a lot of grain of salt. It's, make sure you're working with a group that really understands and is maybe already conservative. So their IRR is conservative. Run your own models and say, great, they said it was going to be an 18 IRR. I come up with it should be a 20. Okay, great. We'll go in and ask that question at that point of like, well, how did you come up with 18? Because I'm actually getting a higher IRR than you. And then kind of weed out how they were conservative. What conservative nature did they take in their model that maybe you didn't? That's one of the things that, that I do is like, I'll run my own models and then say, well, wait a second, how did I get a number that's better than theirs? Let me understand, what did they haircut? So I don't know if you guys have an event coming up on IRR. Somebody has an event coming up on IRR. It's a topic that's been around for a while. There's tons of white papers out there. Super smart people have gone after IRR for many, many years. It's not a bad number. It's just, you have to understand how it's calculated. So liquidity. All right, this is an important one to understand because it's very personal to you. Does an investment match your liquidity needs? Is this a portion of your money that, hey, I can be out there for 5 to 7 years and that's fine? Or is this something to where I'd rather have shorter term? And this applies to any type of alternative investment, because one of the things that you're taking advantage of in an alternative investment to capture an outsized return often is what they call an illiquidity premium. So you're paid a certain return over a traditional, say, benchmark, because you're accepting illiquidity, allowing the manager to go do something that may take a little bit longer to materialize. And you've got to make sure that matches up with you. So this document here, any member desiring to redeem their units in the fund may do so after 2-year lockup period and subsequent to the provider. The manager will notice of intent of redeeming their units in writing. The receipt of this notice will then trigger a start of a 12-month notice period. Okay, so in simple English, this is a 3-year lock. I mean, I don't know why they just didn't say that, but okay, great. That's what it is. And they go through in other parts of the document and sort of talk about a various number of events that are around this 3-year lock and the fees and everything else that are, applicable to it. So just there again, understand what you're getting into. So if you redeem before this 3-year lock, okay, this was an interesting one. The manager has the right to buy your position. First refusal, actually. I mean, this is the actual language of the PPM. So if I need this, let's say I have an emergency, I need to liquidate my position, I actually have to sell it to the manager first at a 15% discount. And they may charge an additional 5% redemption fee. Well, okay, that's not good for you, but we don't really, at the point, if I'm getting out of a fund, I don't really care about the other investors. And let's just be honest. This is all about us. We're diving into this PPM. And the effect being the investor would receive 80%. Okay, you're talking about a 20% haircut, 15% of value that would go to the managers. And they have this as a first refusal. So it's like, if you have any need to get out early, you're looking at a pretty bad situation. They have a couple comments in this PPM about, best efforts and a couple other things, but there again, proof is in the pudding. Ask the question, have you had anybody redeem early? What was the situation of where you were able to redeem someone that didn't have to pay any of these fees? Because let's just be honest. they're always going to take this from you, because if they believe in the project, why wouldn't they buy it from you at a 15% haircut? I mean, it would be a give and trade. I do that all day long. That's like trading 101. Okay, I can make 15 cents on your dollar. I'm taking it every time. So you're kind of stuck with this. And that's the rest of the clauses. The PPM goes on to talk about other possibilities that would be available. You're not going to see any of those. You know, you can pretty much guarantee that you're going to get hit. So understand what that, you know, it says here, the second line, if the fund doesn't, I should have italicized this because this is actually document language. If the fund doesn't want to buy it, an existing investor can buy, you know, it's only a 5% discount and a 2% fee. Well, you know, if they don't take that opportunity, that would scare me. That means, you know, you should probably take the 20% discount, because if they don't want to buy it at a 15% discount, that means something's wrong with the asset. So maybe it's a good thing you get out and get your money. But there again, this liquidity links into, does it match, and are there terms for you able to get out in extraneous situations? I'm not talking about the market gapping and you need your money. I'm talking, you know, a true emergency where, you know, go get a doctor's notice and, hey, I need my money because X, Y, Z. You know, and have they dealt with that situation and been able to provide liquidity without charging a lot of fees? It's something that's important, because let's just be clear. It's a long-term relationship between a manager and their investors. If it's not, it should be. So make sure that the document and the manager has that alignment with you. You know, you keep yourself out of trouble, and you know you're dealing with someone who's going to have some of your best interest at all times, not only from a return standpoint, but from life events. So let's move on here. Further in the liquidity side, let's move on here. Let's see, distributions of profit. Understand the waterfall. And if people aren't aware of what a waterfall is, with regards to an incentive fee, there is a category of who gets paid first in, you know, returns of incentive fees of profits. And so it's just called the waterfall. If you guys want to talk about waterfalls, there's different kinds of waterfalls. We can have a whole other conversation about that. But who gets paid when? You know, the manager has the right in its sole discretion to withhold the distribution if distribution cash would not be in the manager's, you know, in the manager's discretion, be in the best interest of the fund. Okay, that's fine. It's pretty common language in one form or another in a lot of PPMs. Just be really careful. These vague definitions, these are the things you need to ask questions about. This is what you need to dive into. These are the things like, hey, what does that really mean? And when did it occur? When has this ever occurred that you didn't pay something out? And also ask the question of, why did you put this in the document? Give me examples of where this would happen. If you don't know, ask the question. Because when it happens and all of a sudden you're on your heels wondering why you were expecting a distribution and not getting one, it'll be better for you and better for the manager overall, because they built a proper expectation of events that could occur. And if it's an event that they're coming forward and saying, we're not paying it out, and it doesn't match any of the examples they gave to you when you were first doing your due diligence, okay, be on your toes, be ready. There could be greater problems at the fund. Just understand that, ask those questions. And also, if there's any point throughout this, if there's like a specific question, I'm trying to be fairly thorough and give you some real questions and things to go after. That's kind of the point of this. But if there's something that you didn't feel like, hey, I don't have a tool in my toolbox to walk away with regards to this, let me know. Partner contributions. Okay, all hands in. Interesting enough, this PPM had absolutely no section whatsoever ever said the partners were going to put any money in. That's actually pretty rare. In today's world, most people generally expect some level of skin in the game, that the partners will have some amount defined. You'll see certain things, very common language is the managers will always try to be 2% of the fund. Some people will put a dollar amount to it. They'll be like, well, I'll be 2% or at least 500,000, some in nature of to that level. I mean, I've seen some people where, they're very fortunate individuals. So I've seen one PPM say, I'm going to have a minimum of 5 million in my fund. And, they have the capability to do that. That's a great, it's a great indicator. This guy's putting real money where his mouth is. He believes in his fund and he's putting, 5 million into the fund. But one of the questions you can come back and understand is, okay, well, what kind of percentage of that is of your liquid net worth? Give me an idea of what that is. How committed are they to their fund? Is this a really great investment that they're excited about and they're putting a lot of their dollars towards? And if you're not seeing that, then that goes back to what I was saying earlier when I was walking through all the key elements is like, okay, well, if your money's not in this fund, where is it? And maybe I should talk to you about that investment, because that's obviously a better investment because that's where you put your money. Be tough on these guys. I mean, they created this big document and they're telling you to write a large amount of money to them, put them to their test. So this was definitely a red flag for me. This was, wait a second. It doesn't mean they're not putting money in. Just oddly enough, they didn't take the time to put it in their document. So here again, this is that question of walk me through, well, how much money do you put in? And here's one of the things is you can ask for, if audited, you'll get this information. If not, well, ask for information around banking statements and transfers and subdocs. One of the things that Verivest does, which I thought was great, was when they went through Kirkland Capital Group's PPM, Lance called me up and said, hey, you say you're gonna put X amount in, send me all the subdocs that proves that. And I was like, wow, what a great question. If Lance can ask it, well, you should be able to also. Show me those subdocs, show me the legal documents. Do they have a fund administrator? Get the fund administrator's name, verify it, and say, hey, these guys put this money in. The next step is also, there's a few funds I've seen in the real estate space. They have some kind of accelerated mechanism that allows them to recapture their money. Be wary for that. I mean, it's not very common, but I've seen it to where you'll see people like, hey, I'm going to put in, $500,000. And all of a sudden there's some kind of mechanism of where they get paid out sooner than other people up to the point of their contributed amount. Excuse me? So you're getting earlier percentage distributions so that you can cover your 500,000 in sooner than other people. Just be careful. I mean, like I said, this is an art, not a science. If you dive in and you start reading these documents, you will see a little bit of everything. It's a little crazy, but be wary of that. I mean, it's one of the things in real estate that I've seen, in hedge funds, they're under such a regulatory constraint and they have such institutional backing. They don't really get away with a lot these days. VC is next in the firing squad. They're having the government go after them about, tax structures on incentive fees. As venture, as PE, private equity investment, big dollar investment, late stage buyout stuff, it's trickling down into your later stage, mid stage venture. Wherever money flows, regulation follows. Oddly enough, there's not as much regulation in the real estate space, which unfortunately puts more effort on you as the investor to really make sure things really match out, because there's no one really watching or setting guidelines as much as they are in the other private, alternate investment worlds. Leverage. I love this little chart. It always shows that, you're making lots of money. The only problem is when the anvil falls on the other side and the two little guys go flying. So the statement in the PPM, the fund will utilize leverage in various forms, including seller financing, acquisition loans, bridge financing. That's all pretty common stuff, especially in the real estate world. If you're looking at another document, say a hedge fund document, that would really be wonky. That's not very common. So nothing too out of the ordinary here. It's just an understanding of what leverage really means. It is a powerful tool. It can be utilized to capture returns for investors. But one of the things I like to dive in, and one of the questions I like to ask, is get into the head of the manager and ask, is leverage a strategic play or is it a tactical play? Strategic means it is a material piece to the long-term performance of the fund. And so they would not be able to give you the returns you expect as an investor, given the risk you're taking without leverage. That's one of the things you're going after when someone says it's a strategical piece. If it's tactical, it means it's something that they plan on using for a variety of different reasons on a shorter end, and that if they didn't deploy any leverage, it might not hurt their investment goals with regards to what they promised you in the documents and for the fund. So that's one of the things I like to go after. I like to understand where are they going to use leverage. In the hedge fund world, in my previous life, leverage was definitely strategic. I mean, it was very, very important because we were deploying billions of dollars and picking up pennies and nickels. So you needed the leverage aspect and the capability of the power of using other people's money to create the return objectives that was required by our investors. But not every investment works that way. There's enough meat on the bone per se if they're in an inefficient space that maybe leverage is not strategic. So I'll leave it at that. But dive in, get into their head. Valuations. All right, this is a huge issue. This stemmed and became center stage in 2008 because everyone was worried about ratings and valuations and what things were actually worth. There's entire organizations in the government created to better understand valuations. Now, in this document, the stated value shall be determined by the manager at their sole discretion and shall reflect the manager's best estimate of the aggregate value of all its investments on the effective date. Okay, the manager may use one or more methodologies determined in the sole discretion, and they can change their methodology. So I'm not going to bother reading the rest of that. Okay. Here again, not necessarily something wrong, but something to be concerned about and keep your eye on as an investor if you decide to invest in this fund. You're basically trusting the valuation capabilities of the manager. There's lots of conflicts of interest that come out of that. There again, doesn't mean they're bad people, they're doing anything wrong. It just opens the door for things to go wrong. And I always believe that everyone who's going to start a fund doesn't start day one as like, I'm going to rip investors off. Something goes wrong and they'll use every door they can to try and fix the problem or escape out the back. And valuations is one of those doors that you'll commonly see to where valuations are left stagnant or they're just outright lying about it. They're inflating it for one reason or another. And so in hedge funds and a variety of other spaces, this would just not be allowed. It's just flat out, you would never raise an institutional dollar in your life if you were running, say, a long short fund and you had some tier 3 type assets. Tier 3 means it's not publicly priced, and you weren't using a third party valuation source as further verification to your valuation. Doesn't mean you're not running your own valuations and understanding and doing your own work, but you're having that checked by a third party that is going to be compliant with a variety of different rules and regulations that are going to come in and make sure the valuation is correct to the best of their ability, and not just yours. So I hope everyone understands that if you're reliant on the manager to do their own valuations and that's the mark you're going to be taking, there again, not necessarily a bad thing, just could be a problem going forward. You got to get in there. You got to ask for the valuation methodology. Actually, in this PPM, they did walk through an example of how valuation was done. Now, I thought was very interesting in a section right after they gave the example was, hey, we just recently changed our valuation methodology. And then they gave a second example. So there again, I was like, why are you showing an old methodology and then turning around and saying there's a new one? More reading for you, I guess, but that's one of those things, walk through. If you don't understand the example that's in the document, there again, don't be shy. Have them walk you through it and explain why they make certain assumptions and how they structure things, because this valuation is extremely important. It is used in multiple aspects of where you needed to get out in an emergency. You're going to take your 20% haircut off what? Off of their valuation. So, heaven forbid they change their methodology and they mark the portfolio down a little bit at the time in your emergency. you're going to find yourself taking even a steeper haircut, and you wouldn't necessarily be able to prove it. It's also utilized in, when new people come in, because this PPM stated, hey, we can actually bring you in at a certain amount of times at set intervals, and they're setting those valuations of when people come in and how much share they get of the fund at the time of that valuation. Now, depending on that, they could actually, inadvertently mark that higher. Not saying they do that. I'm just saying it opens the door for some flexibility that may not be in the best interest of investors. So there again, you have to find a way to monitor that, really get in and vet that out. Related party transactions. Oh yeah, this is a good one. You can actually, there's some white papers throughout the alternative investment world. This is where so many bad things have happened. There's nothing technically wrong. There again, it just opens those doors of where people can, capture excess fees for themselves, hide expenses. I mean, there's just so many things that can be done. Now, in the premise of this PPM, they're coming across and saying, hey, we have the ability, we have the knowledge, we have all these pieces, and you're going to benefit by having this vertical integration. Sounds like a good thing, but when you walk through the fee section, I don't see any real discounts in fees or structures, because if I was promising you, I have all this stuff that allow you to go end to end, and I have full vertical integration, I'd want to be able to cut those costs to the benefit of my investors throughout that step. That's the advantage of the vertical integration, because I'm basically using all people I know and control and have transparency into, and so that hopefully it costs me less to perform that act, and I can pass that savings on to the investors. I didn't really see that in this PPM, but it's something you can dive in and really understand. But just be wary, because every PPM will basically say a related party transaction is a positive thing. It's going to help you because it's the seamless relationship between groups. But seamless relationships also allowed accountants to hide a lot of stuff. So I got caught once on a related party transaction between two hedge funds, and it was almost impossible to see what was going on behind in accounting relations. And it turned out that the lead accountant for the two groups was embezzling money. So it's very hard to catch some of these people. If you have very, very smart people trying to trick you, they're spending 100% of their day trying to trick you, and you're spending 10% of your time to catch them. Let's just be honest, it's going to be tough. But that's a rarity. So luckily. Risks and conflicts of interest. This is a huge section in every PPM. Some of it will be very generic. If you read enough of these, you'll begin to understand what are the common statements. There will be risks and conflicts that are very idiosyncratic to the type of fund you're looking at. Those are the ones you really want to home in on. You want to understand, well, in this development fund, what is it that's, going to be important to me with the relations of, the projects they're going to be involved in that are ending up in my returns. There's always conflicts of interest. You're never going to escape them, but it doesn't mean there's a negative. It just means, as a manager, I want to give you my best return, but sometimes to get there, I got to charge fees. Okay, that in its nature is a conflict. It doesn't mean it's a bad conflict, but make sure that the manager, and there again, is tracking and justifying the fees as we discussed earlier. This one, the one that bothered me in this PPM here again is, the manager's interest may be in conflict with the member's interests. Well, of course, there is no requirement that the fund create or utilize a board or a committee or unaffiliated members or other advisors to review and approve transactions that may constitute a conflict of interest or a determination of the manager of the value of the fund assets. Okay, this goes back to the valuation situation. I'm very bothered when I'm reliant on the manager. I come from a world where you always have third parties and you have general mandates of how things are treated by large third parties. So there's rules and guidelines of valuation, and you have people looking over your shoulder with that. And to rely on a party that may have other interests other than your your sole interest is the highest returns as an investor, it's something to be worried about. So this one in particular, I'm used to having those committees. I'm used to having those people looking over my shoulder, sort of verifying and monitoring everything. I'm okay with it. Some people don't like that idea, but that's the world I come from. So I'm very used to having people looking over my shoulders. It's kind of required for me. It's what I call sort of the best practices. So this is one, so that's one that kind of jumped out at me is great. They can also do transactions that don't really need to be approved by an outside source, but it may not be a core source or a listed source of what they're going to do. So you can get what they call style drift. So these guys can go out and do other things and other transactions that may or may not be best for the investors. But there's no one watching. The only people watching, the hen house maybe is the fox. So just watch out for that. I always believe in third party. I mean, third party service providers are very important to have embedded into what you would call a institutional class fund. The other one was dependency on key personnel. The company is dependent on the fund manager and the key persons. The departure or incapacity of one or more of these individuals could have material adverse. There's nothing wrong with this statement. It's a key man sort of statement of like, hey, we've got 2 or 3 important people. They get hit by a bus. Okay, that'd be a material issue. The one thing that kind of jumped out at me is they didn't say that what the plan was in the document of, well, wait a second, if that does happen, what happens? Especially in this fund where you could be mid-development project. Buildings are halfway built, or oh my God, we just plowed dirt. What happens? How do we define that? Who unwinds this? How does this all work? That was a little troubling because the PPM didn't actually define what that process was going to be. So make sure that's defined in PPM. Maybe it's embedded in the operating agreement. And if it's not, and you don't find it clear and understood, ask the question. I've actually had a couple of investors ask me that question. If my partner Brock and I, get run over, what happens? In our world, it's a little bit simpler because we're doing debt that's 3 to 12 month terms. Great. If Brock and I are not here, our CFO steps in and moves the debt to maturity and then returns the capital on a pro rata basis. So, I mean, much easier to deal with, but in a development fund, you could be in trouble. You might be holding on to a lot of assets and not really sure who's going to liquidate them. I love this slide because all of this at the end of the day, all this review is trying to get the manager and you aligned. Is this manager in your quick review of these 9 points, and you're talking maybe reading 20 to 25 pages of an 80-page document. I mean, that's the goal. Back to the center of objective of what I was trying to achieve here is how do I get you reading 20 pages, maybe not 80, home in on what's important and get you to that no quickly so that you can assess, well, is this manager aligned with what I expect, given what I need for my portfolio and what I expect to in relation to their investment. Lastly, please, if you got questions after this, don't hesitate. I love talking about this stuff. I go through it. It's been my entire career. Send me an email, reach out on our website. There's a paper that I co-wrote with one of my good friends, John Canaro, who works for a very large investment management shop. Due diligence is a huge topic right now as the alternative investment world is being expanded and opened up for a lot of people who don't have teams of 20 people to read through these things. They don't have maybe 15 years of knowledge or have drafted these before. It's very complex world, and we're trying to write some papers very like this webinar that I'm doing here. In those papers, we're trying to give you questions and things to think about so that you can avoid red flags, identify them, ask the questions about them, and really just be able to move away from things that make you uneasy and defining and help you define what should make you feel uneasy. I know there's a lot of people out there they just don't know, and so that's what we're trying to do. So I appreciate your time. Thank you very much, and I'll take any other questions you might have. And if none at this time, like I said, feel free to reach out to me via email.
You have a comment here. Thank you for the great information. Thank you. It was very informative. Thank you, Chris, for joining us. I also learned more than I have ever known about the PPM.
That's a scary
And I
thought.
appreciate your expertise. So thank you again for joining us, Chris. And if we don't have any questions, you guys feel free to reach out to Chris. He, as you can tell, he loves to inform people on due diligence, and he would be happy to chat with you.
Certainly.
So take care, everyone, and have a good evening.
Thank you very much.